Hi, this is Adam Khoo here. It's the 7th of March, and before the markets open tomorrow, I'm going to talk about my game plan, how I intend to trade from this current market pullback. Now, as you guys know, this pullback was anticipated. It's not surprising. In fact, one day after Valentine's Day, this was back on the 15th of February. I hope you watched that video, which I posted when I said the market is at a high, we are due for a pullback. So that's when I said, okay, let's buy a put spread. So we bought a put option on the SPY ETF. At that level, we say we'll sell a put at the support level. We're going to make some money as the market comes down. Sure enough, the day after this video, the market comes down. So how did I know that? I didn't. It's called luck. Sometimes I get lucky. So sure enough, the market came down and I've already taken profits on my bear put spread, locked in those profits, and now that the market has retraced, what's my game plan for Monday? So let's take a look at the charts right now and let's see what we see. Okay, so we're looking at the S&P 500, ticker symbol SPX. And yep, that was the day of my video on the 15th of February. The very next day, the correction started. And so we have corrected so far all the way down on the S&P to the 50 moving average support. You can see previously this 50 moving average was a support. So what happened was on Thursday, it closed below the 50-day moving average. People freaked out, hit a lot of stop losses, and then the next day, on Friday, the market closed back above the 50 moving average. So that's a pretty bullish signal. So whenever the market is able to close back above the 50 moving average plus with an ice cream bar, which means we've got a long lower shadow, it indicates that the bears push the market down, but the bulls managed to take control and push the market back up, close above the 50 moving average. So based on this candlestick pattern, based on the price action, the probability looks like the market is going to rebound back up next week. Now again, I use the word probability and not prediction. Why? Because remember, no one can predict the market. No one can predict for sure where the market is going to go because the market is driven by emotions and news and sentiment and manipulation. So we can't know for sure 100%, but it's a probability, which means it's more likely to go up from here than go down. So probability means that it may not always go up. It's a chance it'll go up, probably about maybe 60%. Okay? So that's why in trading, you must always know that it could be a losing trade. So in trading, when we enter the trade, we gotta always have a stop loss, and we are always prepared to lose if it doesn't go as we anticipate. And if it goes the way we want, we gotta take profits as well. And again, as trading, we can't be right all the time. We just have to be right a bit more than we are wrong. And when we are right, we make more. When we are wrong, we make less or we lose less. So in the end, we are profitable over time. That's the whole concept behind trading. If you don't do that and you bet all your money it's going to go up, I'm sure that's not trading, that's gambling. So gambling, sure, you can make a lot of money in the short term, but eventually you're going to lose everything because luck doesn't last forever. But in trading, you will always make money over time because you're taking a calculated, probabilistic trade based on statistics. So, like what I'm saying, looks like statistically, market looks like it's going to go up. So we're going to take long trades in the market. We're going to go long, again with a stop loss and a profit target. Now, this is the S&P 500. Now, let's take a look at the Nasdaq because this is kind of like more of a tech sell-off. So we got to look at the Nasdaq and let's see what we see. So the Nasdaq, ticker symbol NDX, we are seeing the same kind of reversal pattern. So you can see previously this 100 moving average, this orange line was a previous strong support during the last major retracement. So this time, again, we have retraced. And on Thursday, we closed below the 100 moving average. But on Friday, we managed to close back above the 100 moving average with a pin bar, a bullish pin bar with a long lower shadow indicating that initially the bears were pushing the market down, but the bulls came back and closed the market higher. So the bulls took charge to control by the end of Friday. So again, from what we see here, the price action, the candlestick pattern looks like, again, the probability looks like we're going to have a bounce on Monday. Again, it's not a prediction, it's a probability. So I'm going to look for some long trades. So once I ascertain the general market direction, bounce up, I then screen for individual stocks to trade. So you can use any scanner. There are many scanners around. So I use my own custom-made scanner. And again, for those of you in our stock trading course, you get all the customized proprietary scripts where we screen for trade setups. So there are many trade setups. The one I'm looking for is called the slingshot setup. The slingshot setup is a perfect setup after the market has pulled back strongly and you expect a strong bounce up. So I'm looking for slingshot setup. So what the heck's a slingshot? So this is my slingshot scan. I just put slingshot and you can see that it screens for the slingshot trades. These are all slingshot trades. I'm going to show you a few examples of what's a slingshot. By the way, this is my own invention, okay? So there are many here. I'm going to show you 3 right now. The first one is Johnson & Johnson. So this is a slingshot setup. Why? Because after the price of Johnson & Johnson has retraced, it has retraced to a level of support. You can see that this is a strong level of support. This was previous resistance, 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 resistance. Now, when resistance is broken and the market comes back down, that resistance becomes potential support. So this level over here, 153, looks like a pretty strong level of support. At the same time, notice as the price came down, it is now technically oversold. Why is it oversold? Because you can see that it has breached the lower Bollinger Bands and the stochastics are also oversold. So we've got 2 oversold indicators. Bollinger Bands oversold, stochastics oversold. It's kind of like a rubber band, right? The rubber band is like oversold, it's gonna snap back. So we have got a bullish candle over here. So we anticipate that, hey, we could go long on Johnson & Johnson and catch the bounce back up. So there are many ways that we could trade this. We could trade the underlying stock. We could buy the stock directly, or we can trade using options. And I'm going to show you the 2 different ways to trade this. Or in fact, 3 different ways today. So that's J&J, that's one setup. Another setup would be IBB. So IBB is an ETF and it's the biotech ETF. And again, it's got that same slingshot setup. So again, notice we've got that previous resistance, and now it's become a support, right? So that's a pretty strong level of support. Now the price has come down and what has happened again? It has pierced the lower Bollinger Bands, which means that it's oversold on the Bollinger Band indicator. On the stochastics, you can see it's oversold, also oversold below the 20 level. And not only that, we've got a nice bullish pin bar. So again, probability of getting a bounce on Monday. Third example, again, there are many examples. I'm just going to show you 3. The third example would be Lulu. Now, where's my Lulu? Somewhere down here. Lulu. Yeah, Lulu. So here's Lulu. And again, you see that support level I've drawn, right? So that's a support tested once, tested twice, tested 3 times. So this level over here, you can see 288 is a pretty strong level of support. So what happened recently? The price came all the way down, went below the support, and closed back above the support with a bullish pin bar, which again is a bullish reversal candlestick pattern. Now, at the same time, you can see that it breached the lower Bollinger Bands, so it's oversold. And if you look at the stochastics also went below 20. So again, oversold on two indicators. Now, what I love about these kind of setups is that I call this a takeout stop pattern. Take out stop, or takeout stops pattern. What does it mean? Now, you can bet that over here, when there were traders that went long, that bought the stock here or bought the stock here, you can bet that what they did was, many of them would have placed stop losses right below those candles low, right? So there are many stop losses here. Now, what market makers do and institutions is they force the price to go down to hit these stop losses. Why do they want to hit the stop losses? So that retail traders, when their stop losses get hit, it forces them to sell their stock at a very oversold price. And who buys all this stock? That's right, the market makers. So the market makers will buy all the stock being sold by the retail traders. Once they've bought it, what's their incentive? Their incentive is to drive the price up again. So whenever you see that the price comes down and goes just below the previous swing lows and takes out all the stop losses, there's a high chance that the market or the price is going to start reversing from there. So again, this could be another interesting long trade setup. So let's now take a look at how I would trade it. So let's take a look at the first example again, J&J. So if I'm going to go long on J&J, there are many ways to do it. The first way is to again trade the underlying stock, to buy the stock itself. So to do that, what would I do? The first thing is I would set my buy order, my stop loss, and my profit target. So in trading, we always use a buy stop limit order, which means we place the buy order above the current price of the trade, so that only if the price goes higher on Monday, it will trigger the buy order. So my buy stop limit order would be about, in this case, about 10 cents above the high of this candle. So what's the high of this candle? If I put the mouse over here, I can see on the top H, the high of the candle is 156.69. So my buy order will be about 10 cents above 156.69, which will be about 156.79. So I'm going to draw a line here to denote my buy order, roughly 156.79, roughly about that, right? Great. So that's my buy order that I'm going to place with the broker. So in other words, if the price goes above the high on Monday, it will trigger the buy order and I'm in the trade. But on Monday, if the price doesn't go above the high, the price goes down, my buy order will not be triggered. So we only want to get in the trade only if the price moves on Monday above the high of this candle. Right, great. So I'm going to buy over there, 156.79. Now again, I anticipate that once I buy, it's going to go up. But again, could it go down? Of course, because again, you never know, it could be a losing trade. So you've got to always prepare for a losing possibility. So if it drops, what do we do as traders? We've got to cut our loss. We've got to put a stop loss. So I place a stop loss at about 10 cents below the low of this candle. So just below the low of the candle will be a 151.37. 151.37, somewhere there. So I'm going to buy at 156.78. My stop loss is once again 151.37. So what's the risk per share? The risk per share would be the difference between these two prices. So let me use my calculator. I take 156.78, 156.78 minus 151.37. Boom! I get $5.50. $5.41. So that's my risk per share. Why? Because every share I buy, I would lose $5.41. If it's a losing trade, it hits my stop loss. I also call this my 1 hour distance. R represents risk. Whenever you take a trade, you must always calculate what's your 1 hour, what's your risk per trade. Why? Because the next question would be, where do we take profit? Where do we get out? And the answer is you always want to take profit so that your profit is always more than your risk. Remember, as long as you make more when you're right and you lose less when you're wrong, you will always make money eventually, even if you're right half the time. That's trading. So we could aim for example, 1.5 hour profit or 2 hour profit or even more. But you gotta aim for more than 1 hour, obviously. So say we aim for 2 hour. So if 1 hour is 5.41, what's 2 hour? Well, multiply by 2, right? So 5.41 times 2 would be 10.82. 10.82. So 2 hour would be 10.82. So what would be our profit target price? Well, 10.82 plus 156.78, boom, 167.6. So let me draw that line in. My profit target would be 167.6, which would be, boom, there we are. And just nice, our profit target is below the previous swing low. So it looks like it's pretty achievable. And the profit target is also below the upper Bollinger Bands, which looks pretty achievable. So again, that's my SL stop loss. My TP would be my profit target, 167.60. Now, next question people would ask would be, okay, so now I get it. I know my buy price, my stop loss, my profit target. How many shares do I buy? Well, how many shares you buy depends on the size of your account. Remember, in trading, when you place a trade, you always risk a small percentage of your capital on any one trade. So my suggestion is to not risk more than 2% of your capital on any one trade. So for example, let's imagine you have got a capital of, say, $10,000. That's your total capital to trade. So what's 2% risk? So if your risk per trade is 2%, which means that in any trade, how much should you risk maximum? Your maximum risk should be 2% times $10,000. Which is $200. Make sense? So in other words, every time you take a trade, the most that you can lose is $200. That's the most you should allow yourself to lose. So this is your total risk. Now, in this case, what's your risk per share? Your risk per share is $5.41. So how many shares do you buy? Check this out. So the number of shares that you should buy would be the total risk, which is $200. That's the total risk divided by the risk per share, 541. So you take 200 divided by 541, boom, you get, round it off, right? You get 37 shares. Ta-da! There you go. That's the number of shares you buy for this trade. 37 shares. So if it turns out to be a winning trade, how much money would you make? You make $10.82, right? 10.82 times 37 shares. So 10.82 times 37 shares, that will be $400. If it's a losing trade, how much would you lose? You would lose $5.41 per share times 37 shares. That'll be roughly about $200. There you go. So if it turns out to be a losing trade, you lose again $200, which represents 2% of your entire capital. And if it's a winning trade, you will win $400, which represents a 4% return on your capital. Another way of saying it is that if it's a losing trade, you lose 1 R. So R represents 2% of capital, for example. And if you win 2 R. So again, if you keep losing 1 R on a losing trade and you win 2 R on a winning trade, you find that over several number of trades, even if you're right half the time, you will be profitable, because again, you win more when you're right, you lose less when you're wrong. And if you get more than a 50% win rate, if you get 50 to 60% win rate, you'll be very, very profitable as long as you keep on trading with this strategy. So what is the disadvantage of trading the actual shares? First disadvantage is that your stop loss that you place at 151.37 is not foolproof. It's not a guarantee that you'll be stopped out at that price, because if there's some kind of bad news in the market, the price could gap down below your stop loss and you end up selling lower than 151.37. So for example, if you buy the stock at 156.78, for some reason, if it again gaps down to say 149, what happens? You lose more than $200. You could lose 250 or 300. So there's always a risk of gapping below the stop loss. Second risk could be those darn market makers or people who manipulate the markets. What they could do is, after you buy the stock, they could drive the price down again, hit your stop loss, causing you to sell, losing $200, and the bastard goes up, right? So that is what could happen. So how do we mitigate those disadvantages? So another approach is to use options. By using options, there's no risk of losing more than the premium that you paid. And there's no risk of them hitting your stop loss and moving it back up. Why? Because in options, we don't use stop losses. There's no need to. So how can we use options? There are two ways. Let me show you the first way. Now, for those of you who are new to options, you've got no idea how they work, do check out my 2 free videos, which is the Beginner's Course Lesson 1 Part 1 and Beginner's Course Lesson 1 Part 2, which you can find on my options trading playlist on my YouTube channel. Remember to subscribe. Okay, so assuming you understand the basics of options, what could we do? Well, the first method is to use what is known as a bull call spread. So a bull call spread is a strategy where we will buy a call option at the current price, which we call it at the money, and simultaneously we will sell a call option at our target price. Now, why don't we just buy the call option? Remember, when you buy a call option and the stock price goes up, you make money. The call options are worth more. But if you just buy the call option, it's going to be expensive. And every day that passes, the options lose value because of time decay. So what we're going to do is we're going to sell a call, because when you remember, when you sell an option, you collect money, you collect premium. And this money that you collect can be used to pay for part of the cost of buying the call. So that overall reduces the cost of your trade. So let's see what strike prices we will choose and how much it's going to cost for this trade setup. So first thing is to go to my trade tab over here, go to trade, and I've got to select a date to expiration. So usually I will select, anywhere from about 30 days to about 40 days. So I'm going to choose about 25 days in this case. That's, 30 days is fine. Or it could be 33, either one's fine. Let's choose 25 days. So I expect that this trade is gonna reach the target in 25 days. So the first thing to do again is I'm going to buy the call option and sell another call option. So I'm gonna buy the call near the current price. So current price is 156. So the closest would be 155. I'm gonna buy this call option at the 155 strike price. How much would it cost? It would cost roughly $4.47. Now bear in mind that right now the market is closed. when the market opens on Monday, these prices would change a bit or may change a lot. So before I actually place the trade on Monday, I would have to relook at the numbers. But this is just an example based on today's price. So it will change, okay? Now, where do I think the price would go in 25 days? Well, based on probability, based on volatility, it shows you in the software that in 25 days, J&J is expected to go up or go down by $9, right? So because we are anticipating it's going to go up, we are going to target a $9 move in 25 days. So what's 155, or rather what's 156 plus 9? 156 plus 9 is about 165, correct? 165. So 165 would be our target price. There we go. So I'm going to buy the call at 155 and sell the call at 165. Now by selling this call, I will collect 85 cents. So I'm going to use this 85 cents to pay for this 155 call, hence lowering my cost to less than 447. So what I'm going to do is I'm going to buy this 155, click buy over there, buy, and then I'm going to sell the 165. Sell the 165. There we go. So how much does it cost me to put on this trade? It will cost me $3.63 debit. Debit means I have to pay for it, right? Paying for it, right? So $3.63 per share. Now, one contract of options is always 100 shares. So the total cost of my trade will be $363. This is also my maximum risk. In other words, the worst that can happen, the worst is I lose $363. Now, what if it's a winning trade and it goes up to my profit target and it expires? You can see over here, there we go. My maximum loss, 363. My maximum profit, 637. Now, if you take 637 and you divide it by 363, you get roughly about 1.75. So that means that I'm risking a maximum of $1 to make $1.75. That's not bad. So again, once again, when I win more. When I lose less. So as long as you win more and you lose less, even if you're right half the time, you will make a lot of money as a trader. Now, some of you may say, but Adam, isn't it better if you risk one to make two or more? Yes, it is. Now, here's the good news. I do not allow myself to hit the maximum loss in an options trade. In other words, I will never lose 363 on this trade. No! The moment the trade doesn't go my way, if the price goes down instead of going up, I will cut my losses manually. And I will lose less than 363. So in other words, I'll lose less than $1. I may lose, say, 70 cents or 65 cents. So essentially, my risk to return is still 1:2 or more. So let me show you an example about what I'm talking about. So the great thing about options is you can analyze the profit and loss chart pretty well. Let me show you what it looks like. Something like that. So on the y-axis, we have got the profit and loss. That's a 0. So anything above that is profit. Below that would be loss. On the x-axis, we have got the price of the stock, right? So right now, the share price is 156. That's the current share price. And we are trading to anticipate the price will go up. So again, my profit target is about 165. That's my profit target, as you can see. Now, if the stock price goes down, then it'll be a losing trade, right? So here's the thing. If the price goes down, I will cut loss at some point. I will not allow myself to let the options expire and lose everything. So where would I cut loss? Well, looking at the chart, you can see that if the price were to drop to say about 150, I'll definitely cut my loss because it means that, it's not going up anymore, right? Okay, so at 150, when I cut my loss, how much would I lose? Well, you look at the purple line and the green line. Now, the green line shows you the profit and loss at expiration, which is the 1st of April, which is in about 30 days, right? So again, I will never hold it to expiration and lose everything. That's stupid. I would sell a lot earlier to get some money back. So this purple line is the profit and loss today, or whatever the date I set over here. So right now is the 7th of March. Let me put it to 7th of March, 7th of March. There we go. Now notice that as time passes from the 7th to the 8th to the 9th of March, as time passes, what happens to the purple line? Watch the purple line as I move this forward in time. So 8th of March, 9th of March, 10th of March, look at the purple line. As we move forward in time, the purple line starts to move towards the green line. Can you see that? It goes up here and it goes down here, until eventually it becomes the green line at expiration. So let's go back to the 7th of March, boom, where we are right now. So let's imagine that I enter the trade and the price goes down. And in 10 days, I say, okay, it's not going up, let's cut loss, right? Okay, so let's simulate in 10 days, it'll be the 17th of March. Boom. Okay, so you can see the purple line would have dropped slightly then. Now, if I cut my loss at 150, how much would I lose? I won't lose the maximum, which is the green line. I'll lose the purple line. Now, if you look at this little box over here, it will show you that the purple line at 150 would be 242. So in other words, if I cut loss in 10 days at 150, I lose 242 instead of the maximum 363. But if the price goes up as I anticipate and it goes up to my profit target, then I will wait for the price, or wait for the option to near expiration, near the green line, and then I'll take my profit so that I'll make as close to the maximum profit as possible. And the maximum profit is 637. So essentially, I'm again risking 242 to make 637. So 637 divided by 242, ta-da, is 2.63. You take this divided by this, you get 2.63, which means essentially I'm risking $1 to make $2.63. That's a good trade. So when you take trades like this, what kind of win rate should you expect? Realistically, anywhere from 50% to a 60% win rate. There you go. Now, you never know when the wins will come or when the losses will come, but you know that if you trade over a large sample, you're going to win 50 to 60% of the time. So if you were to take, for example, 100 trades over a couple of months, and you would statistically win 50 trades and lose 50 trades. Again, it should be higher, but let's just take 50-50. So each time you lose, how much do you lose? Well, in this case, you would lose $242. Let's call this your R, or R represents your risk of the trade, right? So you would lose 50 R. And when you win, how much would you win? You would win, each time you win at least 2 R, correct? So you're risking 1 R to make 2 R. So each time you win 2 R. So 50 times 2 R gives you 100 R. In this case, you're losing 50 R. So 100 R minus 50 R, net, you are making 50 R in profits over 100 trades. Now, 50 R divided by 100 trades gives you an average of 0.5 R per trade, which gives you a positive statistical expectancy. So the more you trade, the more trades you place, the more money you would win, which is on average 0.5 R per trade. Now again, you may say, what the heck is 0.5 R, right? So it depends. So if each time when you trade, you're risking, say in this case, you're risking $240, then your 1 R would be 240, right? Which means on average, each trade you should be making half of 240, which is $120 in net profit. The wins minus the losses. And if you make this per trade and you make 100 trades, that would be $120 times 100. That would be 12000. There'll be $12,000 in net profit. Once again, you could trade the stock directly, or you could trade using the bull call spread options. Now, there's another way of trading this, which is my favorite way, which is called the bull put spread, which is a credit spread strategy. So if you guys really like this video, I'll make the next video. So do give me a like, subscribe, and look forward to my next video where I'll talk about bull put spreads. And with bull put spreads, I'm able to increase the win rate even more significantly. I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.